Okay, everybody, it's 1 o'clock Apple time. You know me, I start on time and end on time. Welcome to our continuing PEP series. We have just a reminder, we have the calendar of remaining events. You can get at the back table there. We also have, of course, my MBA brochure because I am the MBA recruiter here. So if you ever want to talk about MBAs, come see me. We have new technology. We're swiping people in now. Jose is taking care of that for me. Thank you, Jose, for all your help. I really appreciate it. And Jose also has the extra credit sign-in sheet. So if one of your teachers or more is offering extra credit, make sure you sign that. And then I send your names to your teachers and they award you extra credit for attending the PEP Talks. So, I mean, does it get any better than that? Pizza and extra credit and Steve Wilmarth, the bit guy. Today's session with Steve, it's the third in our series of 4, is called Beyond Bitcoin, Altcoins, CBDCs, Property Rights, and the Separation of Money and State. I read Steve's considerable bio to you when we started the series, so I won't read it again, but let me assure you he did not get the nickname the Bit Guy by accident. He is an MIT certified fintech entrepreneur, and his influence extends globally, guiding insurtech startups and leading software and engineering and data science initiatives across Latin America, Italy, the Middle East, and the Ukraine. Closer to home, Steve is well known in our fintech circles, from Crypto Mondays in Stanford to Freedom meetups in New Haven. And of course, the Bit Guy has been active in all 3 semesters of our PEP Talks program. In fact, he had been the kickoff speaker all 3 semesters. He's very loyal to the program. He's very loyal to you, and we appreciate his sharing everything with us. So without further ado, the Bit Guy.
Thank you, Mark. Thank you, Mark. It's always a pleasure to be here for one of these talks. I appreciate the turnout, the faces that I see that have kind of stuck with us through the first 2 sessions, and I hope we can, finish the next 2 sessions and leave you with something seriously significant as a result of these 4 sessions. We're talking about money, so it's kind of hard to do that in a 1-hour talk because money is it's ever present in our life. We all know what money is because we use it every day. But the truth is that money is the money that we use today. You should keep in mind that what we take for granted as money today is a relatively new phenomenon. I'd say that the kind of money we're using today, which is not backed by anything, so money is not a thing. It's a way to exchange value between parties, between 2 people, between 2 businesses, between countries. It's a way to exchange value. So it's not a thing. It's really a kind of a concept or a philosophy. We take it for granted. But the money we use today, for example, we refer to it as fiat money, which is not backed by anything other than government fiat, government law, if you will, government requirement, if you will. What we have as what we call fiat money is a relatively new phenomenon. We could probably go back to 1972 when Richard Nixon took the U.S. off the gold standard, which kind of triggered most of the rest of the world to go off the gold standard and to just use what we call fiat money, which is money created by central banks, by a banking and a finance system, literally created out of thin air. So let me see if I can get my screen back up and running. If I do this, what happened? I gotta log in. We did it last week. How do we do that so we kept it up there all the time? Did the setting change back? Looking over my shoulder to see if this thing's not working.
Thank you, Kyle.
Thank you, Kyle. All right, so last time we were together, after we missed a week last week because of the holiday, but before that, that session we talked about what is Bitcoin, because after we explored what money is and what money isn't in the first session, then I wanted to kind of give you some background on what Bitcoin is. Again, these are topics that are difficult to cover in 1 hour session, but I hope I prompted you with some questions and some ideas that help you get a concept of Bitcoin as this sort of digital form of money, how it evolved, how it developed, and what we call the rise of digital gold, because today Bitcoin is considered a commodity. That's why it's traded in exchange traded fund, an ETF, because in the eyes of the regulators, it's not money, it's a commodity. What is a commodity? Could be gold, could be silver, could be wheat, could be, some kind of food. Thank you, Kyle. So, all kinds of things are commodities. Stone, metals, physical things, even digital things can be considered commodities. So Bitcoin is considered a commodity, like gold, like silver, and so we can refer to it as the rise of digital gold. In talking about Bitcoin, though, I finished last week with a question that kind of stimulated a pretty interesting response, which is, this invention of this digital gold. And we can trace this back to 2008, roughly Halloween night, I think it was, when the so-called Satoshi white paper was released. And that prompted a conversation or discussion that I asked, a question I asked was, who do you think Satoshi Nakamoto is? And why would he do something like this? And that got a pretty excited response. So there's a current, let me just give you some background. This fellow is a fellow by the name of Craig Wright. He's a computer scientist from Australia, and he's claiming to be the Satoshi Nakamoto. He's claiming he's Satoshi Nakamoto. And it's an interesting claim. Why would he claim to be Satoshi Nakamoto, other than the fact that Satoshi Nakamoto is probably one of the world's richest people today, because he mined the first couple of million Bitcoin and put it into a wallet, right? So if you do the numbers, you can multiply that. But it's interesting because that money, that wallet, because of the blockchain technology that we talked about last week, in blockchain, you can go all the way back to the first, what we call the Genesis block, the first block that was ever mined. And we can see literally Bitcoin transactions that go all the way back to that. And so it's like an account, it's like a public account. You can look at it, on the blockchain if you've got the time and the patience to go back and keep a record of every transaction of Bitcoin that's ever occurred in the 15-year history of it. And so the result is that you can see that first Genesis block, or that first Bitcoin that was mined by Satoshi Nakamoto, has stayed in that account and has not left that account. In other words, there's been no in and out of Bitcoin from that original account. And so in 2012, 2013, Satoshi Nakamoto disappeared. He signed off the project. He said, I'm leaving it to the original, to this core of open source developers, and I'm going to move on to other things. Never to be heard from again in any way, shape, or form. Yeah? So now we have this fellow, Craig Wright, who comes along and says, I'm the guy. I did all that. Why would he do that? If he actually is Satoshi Nakamoto and he has the keys, because we talked about the importance of having that private key. Public key is what you need to move Bitcoin or to transact Bitcoin, to mine it, to put it on the blockchain. And then this private key is the way you use it to move it from one account to another. And the private key is what makes it secure, and it's what makes it private, your private property, right? And so wouldn't Craig Wright just simply have to move some money from that original account to another account, just move it, to prove in court that he's Satoshi Nakamoto. Why wouldn't he be able to do that? So there's this big case, and the reason is because this organization called COPA, which stands for, it has to do with the COPA is the Crypto Open Patent Alliance, and open patent. And the key word there is patent, because there are no patents on Bitcoin, no patents filed, submitted, etc. Right? So the original IP, or intellectual property, on this, if Satoshi Nakamoto laid claim to it by filing a patent, in addition to having a lot of Bitcoin, he could get rich, because now he can decide who can use the label. Like any other product, if he has the IP on it, he can literally control and sell and make it a for-profit company, because Bitcoin is an open source project, right? So this debate about who Satoshi Nakamoto is has some real economic consequences, settling that debate. Yeah. So we have this trial going on in London, hasn't been settled yet. They're still making their case. Of course, Greg Wright has gotten into some trouble because they proved that he claims he edited the white paper, but they find out that those claims are not accurate. He was proven wrong. But anyway, the trial is still underway. But the most important thing is, in the course of the trial, this fella, Marty Malmy, was an original developer of Bitcoin. He's the original developer, and you can see from his profile on Twitter, he's from Finland. Is it there? I think. So he's from Espoo, Finland. He's a coder, etc. And interestingly enough, he corresponded with Satoshi Nakamoto in the early days of Bitcoin in 2008, 2009. He was one of the first developers to actually have a conversation with Satoshi Nakamoto. And it's interesting because he said, for example, I'm trying to find it. So he's got here all of this email correspondence. This just went up because he gave this correspondence to the court as part of this case. So I'm going to show you here this string of emails. Sirius was Marty's handle on in email. So he used a pseudonym, as did Satoshi Nakamoto, used a synonym or a pseudonym. And so this is a record. And if you're ever interested to know something about Satoshi Nakamoto, this series of emails, let me see if I can pull it down here. You can see how much, here's the whole record of email. It's a long record. And you can Google this online. This is all posted in GitHub. All of these emails from Satoshi Nakamoto to kind of get a sense, because when we asked the question last week, who is Satoshi Nakamoto, I've got issues trying to expand this. So, when you read this, there are all of this email. There's hundreds of emails in this file. There are no spelling errors that Satoshi Nakamoto ever made. Now, I've never done an email or 100 emails where I haven't had at least one spelling error or one grammar error or something like that. So Satoshi Nakamoto, if he's writing this, and this is 2000, remember this is 2008, 2009, May 2009, when these email exchanges started, who would he be, or she, or they? A university professor, a computer scientist. He claims he wasn't much of a that he wasn't much of a good writer. He claimed to Marty here that he wasn't much of a good writer. So he asked Marty to do the writing for him because he wasn't a good writer. He was a better coder. Well, I think it's unusual to be both a good writer and a good coder. It's kind of unusual to have those skills combined. So I just offer this for those of you that left last session curious about Satoshi Nakamoto and trying to, in your own mind, or test your own thinking against some of the theories that keep coming up about who he or she or they are. Are they a member of the security apparatus of the U.S. government? Who is this? Why did this come out when it did? What are we getting into with this Bitcoin, which is today worth, almost $1 trillion, well, more than $1 trillion, I think, at today's prices. This Bitcoin ecosystem is trading on exchanges at more than $1 trillion. So that's pretty significant, I think. Okay, so I just wanted to share that with you because, again, I think there was some interest last week in this question of who is Satoshi Nakamoto and Bitcoin as we explore Bitcoin and try to figure this out. All right, today I want to talk about alternatives to Bitcoin because that's another major issue that we have today is, things called, tokens or coins, altcoins, CBDCs, central bank digital currencies, property rights, and the separation of money and state. I put property rights and the separation of money and state in there because I think those are important. Those are important issues when we think about these things, these coins that keep coming out, these other platforms, right? These other types of money. And the question is, what is the point? What's the purpose of all of this? So, and next week we'll finish up with, once we kind of we have a foundation of understanding of what is Bitcoin, what are these other alternative coins and these other ways of digital finance. It's now making itself well known in the markets. Where does it all lead? What's the point of all of this? And we'll finish that up next week. Okay, so just expand this. Okay, all right. So when we're talking about these Bitcoin and these other coins, these other networks that are being developed around digital currency, we really have to think of them, and we have to think of the matter of, especially when we're comparing what I like to call the cathedral versus the bazaar. And this concept of a cathedral, when I picture a cathedral, there's an image that kind of fits my notion of what a cathedral is. You've all been to a cathedral. Perhaps in traveling, you've been to some of the great cathedrals in Europe. These are buildings where there was a master designer or planner, a central plan. It took place over many years, sometimes many lifetimes, from start to finish. Notre Dame took a couple hundred years to complete. But they're very, very structured, very centralized. When you walk into a cathedral, you kind of know where things are going to be, kind of know where everything has been planned out, everything's been organized. Sometimes we're struck by the beauty and by the craftsmanship, but it all came from a very centralized planning regimen. A group of planners, a central architect, a grand designer, if you will, right? Versus, and whenever I travel, especially when I travel to Europe or travel to South America or Asia, first place I like to go when I get checked into my hotel is the local market, street market. Because street markets are interesting to me. They're interesting because they're self-organizing. There's no grand planner. There's nobody that says, you should put your stall there and you should put your stall there, and this is how it's going to look. It's kind of organic. It just springs up. People know where people are going to be. They want to sell their wares or their food or whatever, and they set up their own stalls. They make it, colorful to attract people, and you have that image of a bazaar. And for me, that's very significant because, I think of, okay, an economic system, these economic systems that we're dealing with, how should we manage them? How should we set them up? Do we want centralized, cathedral-like, elegantly designed, everything where everything is, everything works? Or do we want something that's more dynamic, like a bazaar where everything is sort of organic and self-organizing? And if we think about money, money is a transfer of value. And so whether it's Bitcoin or cash, or checks or credit cards, it's a way for me to exchange value with one of you, or with someone that's selling something that I want. So I know exactly what I want, or I think I know what I want. I have some money. I'm able to exchange value, and that's great. But that's a system that can happen organically. For example, I don't have any money, but I don't know. You need the trash taken out tonight. I'll do you a favor. I'll take out your trash, because next week maybe I need somebody to come over to my house to help me put on a new door or something. Yeah, there's an exchange of value. There's no bill that was passed in that. There's no paper money that was passed in that transaction. It's simply, I did a favor. There's a value in that favor. I need a favor back. If I trust your name, Jordan, to be trustworthy, I'll extend him that favor. And I'll look for a payback somewhere down the road, right? Now I need he needs a favor. Now I need a favor, right? That's a transaction. That's an exchange of value. In a sense, there was no paper. There was no note. There is a ledger, a mental ledger that says, okay, there's some value exchanged. And so, Jordan and I kind of set up a microeconomy. And you can do that at scale. You can have all of these kinds of exchanges going on without the need for a central bank. There's an interesting phenomenon. It was in Canada, and I can't remember the dates. It was back in the 1970s, I think it was. The banking system shut down for a while. For some reason, there was a crisis, and they closed the banks for an extended period of time. But people still needed to get cash, and they still needed to do business. The response in the community organically was people began to write each other checks. And so I'd write you a check, and you'd take it for some food that I would buy, and then you would take my check over to pay for some gasoline, and the person at the gasoline store, at the gas station, would accept my check given to you as credit. And so during this period of a week or so, when the banking system shut down, people got around it by writing their own checks to people, just on a napkin, a piece of paper. Yeah, and it worked. It worked. It worked temporarily, but it was completely response. People need money. People need to buy things, even when the bank shut down. And so there was this phenomenon that these economies can spring up organically. So when we're talking about money, we talk about economic systems to create this. All right, so I got a little video here. I could play it. I don't want to run too much time. All right, let me run this video. So John Maynard Keynes. Anybody take an economics course? Everybody's taken an economics course sooner or later, right? In college, right? I take an economics course. Okay, so if you learned any economics in college today, in university, you learned Keynesian economics. I doubt the Austrian School of Economics was ever taught in any classes that you attended in economics. But these are two different systems. And I can just give you this quick little rap video that'll explain the difference between the two systems, between the Keynesian model for monetary management and economics, and the Hayek, or Austrian school. Let's see if this works. I can tell you how this ends, okay? So Hayek scores a knockout of Keynes with this point about the economy being organic and the economy being us. and there's no engine, so you can't start it like the Keynesians who, our economic system of central banks and this idea of spending in times of depression or recession, government spending specifically, or the Federal Reserve Bank literally creating more money to put into the system so that people will spend. If you can all remember the checks you received during COVID, right? That's a government program to get spending going, which would keep the economy going, which would, now there's a consequence to spending, government spending, and there are two consequences. One is the debt, because it's all debt. It's all a system of debt, exchanges of IOUs, if you will, between the government, the banks, and ultimately the consumers. But there's a consequence. And one of the consequences is inflation, because we're getting more money into the system. And so each dollar that comes into the system, to simplify it, more complicated than this, but just to simplify it, every time the government creates another $1 trillion for COVID relief, that's roughly the number, $1 trillion for COVID relief, that's debt that has to eventually be paid back. Well, it can be paid back two ways. You can raise taxes and pay back that debt, or you simply print more money and have it deflate the value of a dollar, which is another form of taxation, because it means your spending power goes down. In other words, the thing that cost $1 last year now costs $1.20. Yeah, or a car that cost $30,000 last year now costs $40,000. Yeah, so spending and the inflation of the money supply can create consequences that are similar to a tax. Yeah, you're just paying for it differently. Yeah, and so this debate between Keynes and Hayek. So Hayek was a philosopher who kind of led the what we call the Austrian School of Economics, which is this idea of non-intervention, no government intervention. That these boom and bust cycles that we go through, a good economy versus a depression or recession, they will fix themselves. It's just a matter of people making better decisions or decisions about how they want to spend and earn their money. Now, it's a great simplification or oversimplification of the challenges that we face as a society about keeping people fully employed or employed, keeping our money, sound, if you will, inflation proof. But there are many inputs in this whole very complicated system called the economy. Technology tends to be deflationary. Think about it. Electricity, for example, allows us to study at night, et cetera. It's a deflationary impact on the economy. Today we're talking about AI, the ability of people to be more productive, same number of hours. Using AI, you're more productive. Therefore, you create more value. By creating more value, the economy grows, et cetera. And things get cheaper. So supply chains that were developed, over the last 30 or 40 years have now made products that we normally would have spent a lot more money, large screen TVs, for example, much cheaper, and so that's deflationary. So there's a lot of different factors here that go into economic planning. But it's interesting to know that at the base of it is kind of a question. What do you, a philosophical question. What do you want? Do you want central planning, group of bankers, Jamie Dimon and his friends at BlackRock and his friends at the, and it's like revolving doors, because people that work at the banks usually go to work for the Federal Reserve Bank, et cetera. Government, they transfer between working for the government and working for the private sector. But there are a group of individuals, cronies, if you will. That's why we kind of referring to it these days as crony capitalism. Where this small group of people are making decisions for the entire economy. It's a top-down, cathedral-like approach. Got a master planner, and it's centralized, right? or the other way, which is the Austrian school, which is entrepreneurship, more democratic. Everybody votes with their pocketbook. And we have a situation where, the economy generates corrections organically as opposed to some top-down system. Hayek wrote a book called Road to Serfdom. And that road to serfdom is talking about this sort of centralized economic structures that will lead us back to a time in history when we all kind of worked we were tied to the land, we were tied to a company, we were tied to a political system. In this case, serfdom was popular in Europe prior to the Renaissance period, where people lived on the land, and the value they got, these sort of central planning like communism, the value you get is given to you by the lord, if you will, of the manor. Yeah, and you're tied to the land. Now you get your food, you get your housing, etc., in theory, but your freedom to make choices is limited by the structure that you're in, right? So the question is, do we want this top-down structure? Do we want a bottom-up sort of structure? In Keynes's idea, private property rights are critical. Money is private property, except that it isn't in our system. Your money is not your money. We can prove that pretty easily. You get on the wrong side of the IRS or the government, and the money that sits in your bank account can simply be transferred to pay your debts to the government, if you will. So the question is, private property, and in Hayek's and the Austrian school, private property rights, individual freedom, individual and individualism is more valued than this sort of central planning for the society. Now, these debates can get, it's much more nuanced than I'm sharing with you here. I'm just trying to draw a stark comparison between the two systems. It's much more nuanced an argument, and we get into this debate, we get into this argument. It's part of our political dialogue, our debate, today. And the question is, is there a balance between these two systems? So, let me get out of here. Okay, so, all right. So I wanted to kind of set it up with this debate or this discussion around, these two different perspectives of economic systems and economics, so that when we get into the discussion of Bitcoin and Ethereum, I can draw some distinctions between the two. So Bitcoin, again, is one of these concepts that open source project. There is no company, there is no headquarters for Bitcoin. We don't even know who the inventor of Bitcoin is. He's a mystery. She's a mystery, whoever they are. And so it's it's in the open source community, which is one of its sort of protections, because it can be freely distributed around the world. You don't have to pay for it to be in the system. You don't have to join. You don't have to sign up. You don't have to get a taxpayer ID, unless, of course, you want to trade it, and you're going to reveal who you are, et cetera, so that you can go through the bank's KYC, issues. But literally, it's a peer-to-peer exchange online using an open source protocol. So Bitcoin, has some characteristics to it. Ethereum came out, Vitaly Buterin and Charles Hoskinson and a few others, coders, programmers came up, with what they thought was an improvement on the Bitcoin standard, and created something called Ethereum. And Ethereum tokens, or ERC tokens, are part of the Ethereum network, which represents the vast majority of altcoins. Although it's not just Ethereum, altcoins can be developed, with many other software protocols. What is a coin? Well, so this idea, paper money, when I go to the store and I pay, or a credit card, it's a token of value. It's not the value itself. The value itself is intrinsic. It's a trust factor. It's between you and me, that what I'm transferring to you is is a fair value exchange for what we're exchanging, right? But it's a token. Dollar bills, $20 bills, whatever. They're tokens of value. They're not the value itself. They're tokens. So Bitcoin is a token. One Bitcoin is a token of value that's roughly represented at around $50,000. Okay, you might have a house worth $350,000. That would be 7 Bitcoin tokens. Yeah. So Ethereum also has tokens. Now, the difference in the construction of these two models is significant. Ethereum is open source. It's again public domain software, but then it's public software. The advantage of Ethereum is that you're allowed to put. It was designed so that you could build in these what we call smart contracts, so they could be self-executing. So a certain set of conditions exist in a contract between two people. When those conditions are met, there's an automatic execution of the exchange of value. So again, without getting into the too much of the technical details, one of the advantages of Ethereum was it was built to handle smart contracts on the base layer, or as a second layer on the base, as a layer. How do I describe this? As part of the base layer of Ethereum, right? Smart contracts were calculated to be an enhancement to exchanges of values through tokens. Yeah. So these are the key differences between the two. And you'll see the first one is this supply. 21 million Bitcoin, we talked about this before, and when we were talking about decoding Bitcoin, 21 million Bitcoin is the key number. And it's interesting, if you read the emails from Satoshi, well, why did he settle on 21 million? Just seemed to be a right number to him. It's kind of like pulled out of thin air, not pulled out of thin air, but he kind of felt like that was the right number when he did the calculation. And then he figured that, okay, you could divide it, one Bitcoin, by 100 million units, which he calculated would be enough so that it could be distributed evenly around the world to 8 billion people, or whatever number of people around the world, so it could be distributed evenly. So that's the reason for that number. Ethereum, on the other hand, has an annual supply limit of 18 million. What does that mean? It means that in the future, the Ethereum, the use case for Ethereum could be expanded to 18 million a year. So just year in and year out, you can add 18 million to it. That sounds inflationary to me, and that's one of the differences. So inflation, it's an inflationary supply style, much like fiat currency, which makes more tokens that can be made over time. Proof of work has been replaced in Ethereum with a proof of stake model. And again, I don't want to get into the details here, it would take too much time. But proof of work is the standard by which Bitcoin is created. There's no proof of stake in Bitcoin. It's all proof of work. They had a big argument or debate among the core developers about whether they wanted to use proof of stake. Proof of work requires an input of energy, electricity specifically, or energy, to mine Bitcoin. And again, that's what gives it both security and value, is having a proof of work concept or standard by which you can prove that you have created value that gets you some Bitcoin. In Ethereum, this proof of stake model it's much easier. The stakeholders themselves can set the standards by which your token, if you will, is issued to you, right? not through proof of work, it's through a proof of what they call proof of stake. You just have to prove that you have this token to be part of the Ethereum network. Again, I'm oversimplifying it here for reasons of being able to continue to move on quickly. But proof of stake is much lower energy intensive. And so people say, well, Ethereum's good for the environment. Bitcoin's bad for the environment because of all the energy it uses. The truth is that that's pretty much an oversimplification of the energy issues around Bitcoin or around Ethereum with proof of stake. Operations and storage determines the transaction costs. Transaction cost in Bitcoin is determined by the amount of the Bitcoin traded. So there are these factors with Ethereum that make it more centralized, more of a, there are companies that are created around Ethereum tokens. So for example, a gaming platform that might use Ethereum as a token to exchange. If you get rewarded for winning the game, you get Ethereum tokens or some kind of Ethereum token. But there's that company, that gaming company was created to make a profit. There's a group of people that run it. That's why we can get into situations like FTX and some of the other scams that have occurred. Bitcoin tends to get painted with the same brush, but these Ethereum networks that get created like FTX, Binance could be argued. Some of these other networks, dark web kind of things, create the potential for people to do bad actors to do bad things, like pull the rug out from original investors. So you'll see some of these coins. There's more than 15,000 altcoins. Anybody can create an altcoin. Any company can create an altcoin. We've had Sam Altman talk about WorldCoin, which is a way to create some value using AI in a monetary system. And so we have these different ways of creating coins in the Ethereum space or in the altcoin space, but usually they're considered by the SEC, for example, to be companies. And so there's something called the Howey test, which is used to determine if something's a security or a commodity. And Bitcoin passes the Howey test as a commodity. Ethereum, on the other hand, looks more like, to the regulators anyway, like a security, which means it needs different kind of regulation. Okay. A lot of people, maybe in your network, maybe people are trading altcoins, looking to get rich quick, perhaps. You can buy some of these altcoins at a very cheap price, if you will, and if they pump, they can go up 20x, 100x. I know some young people that bought some Ethereum coins, Ethereum Max, a few years ago, and it ran up very quickly. It got endorsed by Kim Kardashian and Holyfield, and the coin value ran up quite a bit. People got really excited. They were getting rich very fast. $10,000 investment for one friend of mine turned into $250,000 in a matter of months. He was feeling pretty good, and then it went to zero very quickly. And when it starts to drop at that rate, there's no way to get out. You essentially, unless you know what's coming, and unless you have a way to front run that, you're going to get caught in that scam. And a lot of the bad, the bad stories, the negative stories around digital currencies arise out of these scams, which are nothing more than pyramid schemes. First people in make a lot of money. They're the stakeholders, if you will, of these coins. They can issue God knows how many coins to themselves at no value. As other people come in and put money in, it's like a pyramid scheme. It runs up in value. Then they pull their stake out. Maybe it's coordinated, maybe not, but it happens. And then the people that have actually been buying on the way up get rug pulled. Okay. This is a picture of the Ethereum development roadmap. Roadmaps, if any of you are in software engineering or software development, roadmaps are pretty critical. It's like how are you going to get to your end product? What are you going to do to get to your end product? And I just put this up there because the Ethereum roadmap is pretty complicated. You can sit for hours and try to figure out where it's going, what it's doing, what their sense of getting to a finished, it's still a work in process. How are they there? You see the past, the future on each end of this. This roadmap is pretty complicated and makes me wonder, is Ethereum too complicated? There's something called Occam's razor, which is a philosophy that says that the simplest solution is usually the best. To me, Bitcoin is pretty simple, pretty straightforward. I can understand it. It takes a little bit of work because you have to understand what money is and these other things. But the white paper is 7 or 9 pages long. And again, it's easy to download. It's easy to read. It reads like a research paper at a university, so it's understandable, etc. So, in my opinion, again, Bitcoin versus altcoins, it's pretty simple to understand. All right, I want to finish by talking about this. So let me finish up by talking about CBDCs, central bank digital currencies, because this is another form of digital currency. Again, they use some kind of a base token system. Probably most CBDCs are being developed on the Ethereum standard, not the Bitcoin standard. You can't actually do that on the Bitcoin standard. The Bitcoin standard is the standard. You can download the source code and you can change it, but you're not going to have anybody on your network, so there's going to be zero value. The only thing that gives Bitcoin its value is the fact that there's 150 million people around the world that are on that network. Okay, so I have a tracker here for central bank digital currencies because this is something that's coming. You'll hear about it, particularly as we get into the political season, because there's going to be a group of people that are going to say we never want a central bank digital currency, and there are those that say, well, it's the wave of the future. But when we go to a central bank digital currency, you won't need a local bank because all the money will be programmed. It'll be digital on this Ethereum-like network with smart contracts. We won't need local banks, which is kind of one thing we have to think about. This tracker allows me to kind of go to countries. Let's just take China, for example. And so the Chinese have launched their central bank digital currency. They're actually using it now in China. And you can see the monetary base, the economic information related to it, the GDP. It's a big GDP. It's a big country. It's a big economic zone. But money in China is programmed. I was in China in November. I used my phone. I have my WeChat account. My wife, who's Chinese, put money in my WeChat account so that I could travel freely in China. I used my phone, my WeChat account, to buy my train tickets, to buy my hotel, to buy my meals, my Uber, everything, right? And it's just a QR code. Like Bitcoin, it's just a QR code. Somebody snaps a picture of my QR code. Transaction takes place between my account and the vendor. I was in Shanghai, 23 million people. You can imagine. New York is 7 million people, 6 million people. It's pretty crowded, but a city like Shanghai is even more crowded. But they've got wonderful, clean and open and and efficient, and comfortable subway systems and taxis, Ubers, etc. It's very easy to get around the city, right? I noticed as I was walking to the subway one day, that, all of these people are on the sidewalk. And of course, I'm from New York. So if there's no traffic coming, I'm not waiting for the light. I'm going to take a walk across the street. I'm going to jaywalk, right? I noticed that all of these people on the corners, nobody was stepping on, not even stepping onto the pavement in anticipation of the light changing until the light changed. Of course, I'm from New York. I made the mistake. I stepped off to get a head start on everybody. I stepped off the curb and I went to the subway and tried to use my subway card and it didn't work. What happened? Well, my picture was taken as I was jaywalking, and my card, my subway card, which is tied to my passport, my name, my identity, was immediately turned off for 3 days. I went to the information booth. I said, I paid for this subway card. Why doesn't it work? And they looked it up on the system. They said, oh, you were jaywalking. So, that's the power of a digital currency, that can be tracked and tied to your identity. Again, the question is my money, or does it belong to the state? Is my money, or does it belong to someone else? And so in China, for example, central bank digital currency is the way they can, there's strong capital controls in China. You can't take your money out of the country. You can't convert it to other currencies. If you're a Chinese citizen, limited. You can do it on a limited basis, but you can't transfer your wealth. You can't invest in certain things in the U, like real estate in the U.S., et cetera, without some special, permission from the government. If I go to, if we go to Europe, we're going to see that, for example, in England, they're doing research on this. If we go to here, we go to the U.S., Canada. So Canada is doing research. The U.S. Is in a pilot. They're running a pilot program in the U.S. on this. So they're doing research in Europe. Several countries in Europe are thinking about issuing a CBDC. They're doing a pilot project in the U.S. There's something called Fed Now, which is a CBDC between banks, creating this CBDC between banks. They're piloting it. They're not taking it down to the retail level, to the individual level yet, but it's very controversial. Because if we do a CBDC, a central bank digital currency, it means that you're going to be, it's really great for a surveillance economy where they know where you are, who you are, your identity is known. You do transactions that are illegal or whatever, they're going to immediately show up. And so the government has, and the security, and people will argue. Again, they argue in China. Again, people that live there say, well, we don't have any crime. We don't have any jaywalking. We don't have any people doing bad things. We don't have any people buying drugs. We don't have any people doing things that they shouldn't be doing. We like it. There's no crime. Yeah? In a certain sense, right? There's no crime. Here in the US, we like to think the other way. Our personal private property belongs to us. Private property rights are something we fought a revolution over, and formed a country around. This idea of individual freedom and private property rights, back to that Hayek versus Keynesian argument of what do you want? Do you want central control for organization, for the beauty of the cathedral, for the ease of navigating the cathedral, versus this sort of disorganized and noisy open market system, free market system, where individuals have their own property, maintain their property, have the right to transact as they see fit. Even if some people are doing bad things, everybody else can make decisions about their own money without the interference of a higher authority. So these are the big questions that I'll leave you with today. I'd like to take any questions. As you know, I'll stick around afterwards to answer any questions. But I wanted to cover this difference between, the the difference between Bitcoin and altcoins or CBDCs, and also this question of central planning of the economy versus organic economic activities and exchanges, and this idea of private property. How important is it? So, with that, can I answer any questions, or do you want me to ask the questions?
With the United States and the Federal Reserve Board, would you say we're more toward the centralized control?
Well, so we've been moving in the direction of central control ever since. Remember that the United States did not have a central bank for most of its history. We had an attempt at the central bank under the big debate between Thomas Jefferson and Alexander Hamilton was around whether or not we needed a central bank, because we had a very bad experience during the period when we didn't have a national constitution. We had a confederation of states. And so every state was printing its own currency, and every state was creating its own, banking system, et cetera. And so we had a problem being able to have an army, paying soldiers, et cetera. Shays Rebellion. We had all of these issues, right? So we centralized, and then Alexander Hamilton said we need a national bank. And Thomas Jefferson said, no, that's going to make a few people rich, and it's going to make everybody else poor. That's the road. Jefferson didn't say this, Hayek did, but Jefferson would have said that's the road to serfdom. We just fought a revolution. We don't want to go that direction. So we didn't have a central bank. We had another central bank that was created in the 1830s, but Andrew Jackson famously abolished it. We didn't have a central bank again until 1913, when the U.S. created the Federal Reserve Bank. Now, it's an interesting name. They didn't call it the Bank of America, like the Bank of England. They called it the Federal Reserve System. And it's a private company owned by banks in the system, but it's not a public company. It's a private company, the Federal Reserve System, that is entrusted with managing money in the system. It can create its own debt instruments. It can flood the market with cash, with money. It doesn't mint or print money. That's the Treasury, U.S. Treasury's job. But the Federal Reserve System does create money by creating large, bond issues, Treasury notes, Treasury bills, et cetera. Again, all usually at the request of the U.S. Treasury, but it can create these things that can then create money within the banking system. So we're moving in the direction of more central authority. And this is a debate we're having, more and more frequently, and particularly Bitcoin and these digital currencies and CBDCs are stimulating the debate. It's getting people focusing a little bit more on these questions that we've been addressing in the last 3 sessions. It's getting people to think more about, okay, what is money? Is it something that is organic? Is it something that is between us? Or is it something that needs to be controlled centrally? And again, throughout our history, if you study economic history in the U.S., the Great Depression, the panics of the 19th century, all point to, okay, we need some way to manage this kind of economy, or otherwise we're going to have great, run-ups and bubbles, if you will, and then recessions or depressions that follow. Yeah, so it's complicated, but yeah. Any other questions? And I'm going to let you go if you need to go to class or whatever. But again, I'm happy to stick around and answer any questions or continue the debate.
Thank you so much, Steve.
Yeah.
It's always great. I always enjoy it. If you get just a reminder, if you're signing up for extra credit with any of your teachers, please sign this sheet and indicate where. And I'd also like to give a shout out to my friend Kyle, who helps us with all of our technical issues and makes sure that the show does in fact go on. So thank you, Kyle. I was remiss in not recognizing you earlier.